Well, we are seeing some companies succeed in restructuring their debt out of court. Many others can't resolve their issues outside of bankruptcy protection. John Madden, a senior managing director and founder of distressed-focused financial advisory firm Emerald Capital Advisors, is here in the studio today to talk about why that is. So John, what distinguishes a restructuring situation that can be resolved out of court with a situation that needs to go to bankruptcy?
Well, I think in order to do an out-of-court restructuring and effectuate it properly, you really need consensus amongst your stakeholders. So as such, an out-of-court restructuring generally is going to involve a company that has a simple capital structure, a single lender, maybe a small group of lenders, small group of bondholders, high concentration of the debt amongst a small number of people, little to no trade debt. Those are important characteristics. Also, it's imperative that you have a strong underlying business. This is going to really improve the chances that your creditors are going to buy into the process and play ball. And also, it eliminates the need to use Chapter 11 and some of the tools that exist in Chapter 11 to fix some operational issues, such as the ability to reject contracts.
Okay, that makes a lot of sense. So today, why are a lot more companies turning to bankruptcy rather than finding an out-of-court solution?
Well, I think there's a number of reasons. The main thing, I think, is there's been a slight uptick in defaults over the last couple of years. And with that, there's a little more uneasiness amongst the lender group. And definitely you see in the middle markets that capital markets have tightened for middle market companies. Access to capital is not as robust as it used to be. So you see middle market companies turning to Chapter 11 a lot more to restructure. With that said, what you're also seeing within the middle markets in Chapter 11 is there are a lot more sales as opposed to reorganizations. I think this is a further example of how lenders are a lot more uneasy with regard to middle market companies. With regard to larger companies, I think what you see going on is because the capital structures in larger companies are a little more complex, it's a lot harder to get the consensus I talked about before and do an out-of-court restructuring. So you see kind of the next best thing happening, and that would be a prepackaged Chapter 11 or a prearranged Chapter 11, where a lot of the work is done pre-petition, but then a filing needs to be done in order to effectuate the transaction.
Okay. And when you think about the deals that you're seeing get done actually out of court, do you think they're providing long-term sustainable solutions, or are they more of a Band-Aid?
Well, it's really on a situation-by-situation basis, but in general, I'd say they're Band-Aids. And that's really because the distressed companies we're seeing these days are either just bad businesses, or they operate in bad sectors, or they're way over-levered, or all three. And that's a generalization, but that's a lot of the situations we're seeing. So amend and extend or some additional liquidity really doesn't fix a problem for that type of company. And what's necessary is a full, thorough, operational balance sheet fix, which only can be effectuated through a Chapter 11 process.
Okay, interesting to keep in mind. Well, thank you for joining us, John. And I'm Lisa Allen with The Deal.